Action.
Welcome back. We're at another mid-quarter roundtable. So I think it has been 3 months since our last one, end of February. I think February 29th, actually. So we might not be able to do that one for another 4 years. But we're 3 months later now. Thought we'd talk about how the markets have done, and then maybe get into some detail for why we think that's the case. First number, the Dow is up about 5 basis points. So figure it's flat since our last roundtable, but still up about 4% year to date. The S&P's done quite a bit better, up 5% since the last roundtable, and about 12% year to date. The NASDAQ, again, that's the tech names, and that's driving a lot of the market's performance. We're going to talk about that here in a little bit. Has done quite well. It's up about 6% since last roundtable, and about 7, almost 8% year to date. And then we get to our bonds, which have not done as well, but still up. We'll give them 1 basis point since the last roundtable, causing Kyle to be correct that bonds would be up over the next 3 months. So he nailed it. He's right on that one. But they are still down. It's been a rough go for bonds, and we'll talk about some of the reasons for that. So they're still down about 1.7% year to date, following the previous couple of years where they've been down. And then lastly, commodities have had a big rally. So commodities are up about 10% in the last 3 months, and then about 9% for the year. So those are the numbers. I think what's more important than the numbers, though, is what's driving the market. I think that's why people tune in to listen to this. So let's start off with some of the things that are driving the market forward right now.
It still seems to be tech-driven. That's why you see the biggest year-to-date numbers of the NASDAQ, which are tech-related numbers, or tech-related names. And so what I've got here, a couple charts. I'm going to show the S&P 500, which is an index we're all familiar with. But I've got the S&P 500, and I've got it compared to the same index, but instead of it being weighted, the index, if you all don't know, the S&P 500 is weighted by size of the company. So Apple Computer and Microsoft have a much bigger share than Walgreens, or names like that. And that makes sense because of the way we use their products. And now the S&P 500, I want to say that the top 7 names represent a third of the index. Does that sound right?
It's probably close.
And so what we've seen here, and you can see the performance between the regular S&P 500 that we see on the news and the equal weighted S&P 500, where all 500 names have the exact same share of the index. Over a long period of time, these track very, very closely. But we did see a breakout towards the end of 2022, starting 2023, when one started to pull away. And it was those big names at the top of the index, the big tech names, started to pull away. And the coincidence around there, the driver that started that was all the AI conversation, the AI talk, ChatGPT, really started to drive the impact that what people believe their influence will be going forward. The names like Microsoft, the names like Google, Amazon, and then the biggest driver of them all, NVIDIA, which I'll show another chart on them in just a second. But what this one here too can also show what we've seen a massive change here just in the last 12 months. Historically, smaller companies and middle-sized companies have outperformed larger companies, and that's really just because they've got the ability to grow faster than bigger companies. Once you're already big, the law of large numbers can really kind of eat at them. When you're worth $500 billion, let's say, which some of the bigger companies have been, getting up to $1 trillion in market cap, that's a lot of work, versus a company that's worth $50 billion getting up to $100 billion. And so it makes sense that the smaller companies and middle-sized companies and those indexes have outperformed, but you'll see just here in the last 12 months, it's the mega caps, the giant companies that really took off. And the big question is going to be whether or not that is sustainable, which we can get into a little bit. But the biggest driver of them all has been NVIDIA. And for those that aren't that familiar, NVIDIA is the microchip, the chip manufacturer that is supporting any companies that are really wanting to be on the front edge of AI. They're needing to buy these $100,000 chips and data servers and warehouses and really to kind of support this. And so the bearish folks are the people that are the naysayers are wondering if NVIDIA is going to be, Intel or the next Cisco Systems or something like that, where they had a big run, but then other companies nip at their heels. I remember hearing that there's a Jeff Bezos quote that says, your margin is my opportunity. Mm-hmm. And right now, NVIDIA has unbelievable margins because no one else is making a comparable product. But, they're not just making tires either. I mean, these chips are incredibly complicated. Their newest, what's the newest chip called? H100, I think it's
You would know.
Yeah.
and so this chip, it's not just the chips like you've seen before, like those old commercials with Intel or something like that. These chips actually weigh 70 pounds, and so and they're going for $100,000 each.
Well, remember when it really took off, it was because people were mining Bitcoin with these chipsets.
and
That was the
and
big
gaming.
start.
Yeah, I was gonna say. So Nvidia's been around forever. Nvidia it has been known for graphics cards for a
exactly.
really, really long time. But and then obviously the rise of gaming. I mean, I don't know the numbers, but we all know how many kids play video games now versus 20 years ago or 30 years ago. But they've been around for a really long time. But then all these factors, and like you said, the AI is really just taking them to a completely new level.
Well, and you'll see the level on this chart. So what this chart is, this is going back a few years, and this shows the size of the companies. The market cap is the term we use. So you can actually see how fast it has taken over other companies. And so other names you have in there is Meta or Facebook. You've got Google, you've got Apple, and you've got Microsoft. And just in the last 12 months, it's blown through 3 of them, and now it's just about ready to pass Apple to be the second largest company. And so the debate that we've got is kind of figuring out, okay, obviously this is pricing in a lot of expectation going forward because this company has gained $1 trillion in market cap over the last 30 days. Right? They're not selling any more. I mean, they're selling the same amount of chips that people expected them to. That hasn't changed. The expectation is what are they going to sell next year, the year after, et cetera. And then debates too on the other side is like, okay, once Microsoft and once Google and once Amazon buy all the chips that they need for the AI they want now, they're not going to have to keep replacing all of these chips every 6 months. And so is there going to be some saturation? Time will only tell.
Well, there's talk too about Amazon getting in the business there too, trying to build their own AI chips too. I mean, that's going to be down the road a little bit, but you said before, your margins are opportunity. So eventually other companies are going to try to make the same quality chips and eat away at some of that market cap.
I think they will. I just think it might take a little time, but then how much of that time is already priced into a $3 trillion market cap? And so it's not just the market cap, but I've got another chart that's interesting too. It's a ratio that we use, something called PS ratio, or easier to understand as price to sales. And so what that means in English is you take the value of the company and you divide it by its gross revenue. Just take the highest number. So this
Not
is
their earnings, revenue.
So this is before they pay taxes. This is before they pay rent. This is before they pay employees.
Cost
this is
of
before they
goods,
pay medical.
everything,
This is before they pay for the cost of goods. This is the biggest number at the top of the list. So you take that number and you divide that into the value of the company, and you get a number. And so the second most expensive company out there has a PS ratio of 22. You can see there's a lot of companies trading in the teens, and most of them are either software-based, pharmaceutical-based, things like that. Microsoft, the biggest company in the country, has a price-to-sales ratio of 13. NVIDIA right now is almost 40.
And you're not seeing those same mega cap names. I mean, you look at the names that are even, they're not even comparable. They're not even that close. But Fair Isaac Corp Software and Intuitive Surgical, those are not mega cap companies,
right?
Which is crazy. And so the one thing too is that, without getting too dumbed down, but like, I mean, at the end of the day, when you're buying equities, right, stocks, so you go back to like just investing 101, you're buying a future stream of cash flows.
Mm-hmm.
So at what price does that future stream of cash flows not make sense? And in like Warren Buffett always says, I know Chris uses this all the time, in the short term, the market is a voting machine, but in the long term, it's a weighing machine. So at some point, you may be paying too much for, you're never going to get those cash flows back. We don't know the answer, because that's the thing about stocks, the thing about equities, right? There's no permanence. But that is a huge, huge number.
Well, and with that ratio, and not that they can't, I mean, companies have done it, not a lot, but I mean, they have to hit like 5 more home runs in a row.
Yeah.
I mean, it's priced in, so when we get clients ask, hey, should I start buying NVIDIA now? I mean, we're not saying it's going down, but it looks very fully valued at this point, unless.
Well, and like you said, I was going to say, like you said earlier, I mean, now it's almost a $3 trillion company. I mean, how hard is it to get from 3 to 6? It's pretty damn hard.
Right. So the performance that some have been lucky enough to obtain up to this point, it's unlikely. It would be very difficult for NVIDIA to double again this year. Which people say, well, it already went from 200 to 1,000. Why can't it go from 1,000 to 10,000? And it just doesn't work that way.
We should do something on stock splits at some point too.
Yeah,
because
Interesting.
That seems to be one of those like
Yeah, it's going to
hot
split.
button
Does that
things
mean I have more money?
no.
Well, let's be clear too. It's not a meme stock. This isn't AMC
they're
or
legit.
GameStop. This isn't somebody artificially pumping the price of it up and then it's gonna fall. So completely different than what's been what's happened in the past or in the news. Nvidia is a great company. It's a legit company, but at some point everything has a value. It's you go back to anything you own. Everything has a value. Is a car worth $50,000, $100,000, $1 million, $10 million? Like,
well, what the market's saying is it's gonna grow right into that value.
right, it's just going to
They're
grow
just gonna
exponentially
keep
forever,
growing. Yes.
which we know is not possible. Not at some rate of growth. It's
Right.
just not sustainable. So interesting.
But when you get into these frenzy type situations, all you have to do is say like words like, "Well, it's AI," and that it just excuses it, right? You can pay anything because it's AI.
It's different this
Or
time. It's AI.
Yeah. Oh, it's tech. Well, then it can keep. And I always think back to like names like Cisco Systems, which was this is a long time ago, but it was the largest company in the S&P 500, like by a long shot. And then in about 6 months, it wasn't. And it's still a very viable, very, very good company. But I'd have to look back and see if they've even gotten back to where they were valued 24 years ago. I think they might be close now, but
Yeah.
it took a long time for it to finally go. But all that stopped was this massive growth. It just went from, we're not growing at 35% anymore. Now we're only growing at 27%. Oh, we must be trash. Boom, the stock goes way down.
It does.
So
It does seem a little bit like early 2000s. Not that there's going to be a tech bubble and a crash, but
Yeah.
just like at some point, you just can't say it's AI and just keep pumping it up. But
yeah,
Well, they're going to have to
But it's
continue to
happening.
develop the chips, right? They're at the AI front with the chip, just like it was with the graphic cards. There has to be an evolution to their product over time if they're going to continue to grow, because at some point the market gets saturated. It has all their chips, and so it's either you're going to have to keep making bigger, better, newer chips that have that demand, and so you're going to have to stay ahead of all your competition to have that level of growth.
That's so one thing. I'm actually going to try to pull that chart back up on the market cap, and this kind of ties back. That's a good comment, tying it back to, let's say, Apple Computer. And so if I bet all of us right now would not get this right. We all have our iPhones in our pocket or in our office or whatever. Do any of you know exactly what iPhone series you have?
what do you mean?
13, 14, 15?
I do, because I have the oldest one in my household. We had this discussion this weekend.
yeah,
I don't.
Yeah. You do lose track. I have to look it up. I just happened to look mine up.
Because there's no difference anymore, right? Other than the camera's a little bit better, the battery's a little bit longer, but your motivation to go stand in line is not what it used to be when iPhones first came out. And so now you can look at Apple's market cap going back 3 years, it's dead flat. Because to Kyle's point, unless you're innovating and you're making a brand new product that people want,
Yes.
it's like, what's the motivation to buy it? So that's going to be NVIDIA's challenge. Now, right now, their advantage is they just came out with this brand new H100 chip that everybody wants, but it's the greatest thing out there. And again, until it's not, but they've got the capital now. They're doing the R&D for the H200 chip.
Oh, yeah.
You know what I mean? And
Absolutely.
that's probably going to still be more advanced than, AMD or someone else nipping in the heels. So I think they've got a moat for a while, but so did Apple. You know
Yes.
what I mean?
Yep.
And until they get saturated in the market.
So I just pulled it up. Cisco, we might have to strike this from the podcast, and I don't care if we do, because this is the truth. It was $80 a share in March of 2000, corrected for splits and everything else. It's at 46 now. It's about half of what it was at its very top when it was selling at that kind of
And again,
price to sales and all that stuff.
and that goes back to
and they make
sorry.
way more money now as a company, profitable. They're
Well,
making way more than they were making in 2000.
It's
And-
expectations. I mean, you can take another name that
Exactly.
was on there that was hot for a while, was Tesla. Now they're selling way more cars now than they
Yes.
were 5 years ago, but the stock is half the price of where it was
Yep.
because people are all
Anticipation.
expecting that ski slope.
Mhm.
And when is it going to roll over?
Yeah.
that's a
So-
single stock risk too. If you
Yeah,
bought
for
Cisco
sure.
back then, you have less money today after 25 years. So
Yeah, and
not
we're not
great.
talking about it. It didn't it just happens to be back down now. It's the highest it got back to was looks like $63.
Yeah.
Corrected for splits, $80 in March of 2000, and
Wasn't
just
it
went
worth
through
$1
this
trillion
trough.
at 1 second?
Yeah.
Right?
That was when it was. Like I said, March of 2000. It was boom, $1 trillion, first $1 trillion company, and then never to be seen again.
yeah,
never
Even though
good.
they
Even though they sell
got-
more now
they
than
got
they
more
did then.
employees now. They got way more sales. They make way more profits. It just the growth went from we're going to double, we're only going up 20% next year. Oh, you're garbage. Threw you out.
Yeah.
And it got flushed with the rest of the .com stuff for sure. But it was viable and a really good company. So it's really crazy how some of those happen. And I mean, Coca-Cola. Look at Pfizer right now. I mean, Pfizer's really, the stock itself is really struggling. I would guess without looking, the company's probably making just as much money. But the growth expectations go away, and immediately all the foam is gone off the top.
Yep.
So you got the company like NVIDIA or Tesla or whatever. They just have to. It has to be perfect. They have to execute
Keep
perfectly,
innovating.
and it's almost impossible to do. Like nobody's ever done it. And it's shocking how fast some of these, I mean, NVIDIA has gone up in terms of value. I mean, it's up another, 50-60% this year so far.
Well, and we hit on it in the previous podcast too. It's
Crazy.
It's going up in the face of rising interest rates, right?
Right.
So historically, tech doesn't do that, right? So we expect with rising interest rates, the NASDAQ to come down a little bit or give up some of that, and it's still gone straight up. So
The hard part is, like, and you said this earlier, when you have 7 stocks that make up 30% of the index, it's hard to even figure out what the rest of the index is even doing, because you have these mega caps that are moving the whole thing all by themselves. It doesn't happen as much in the Dow, and that's what part of why the Dow number's not as high, because it's obviously the calculation's totally different. They do it very, very differently. But with any cap weighted index, you could have 470 stocks that are down for the year. And everybody's going, well, yeah, but S&P's up 12. Like, isn't that a good thing? Yeah, but it depends on what you own.
Well, we talked about that previously last year at one point when the S&P was up like 17% and the Dow was up like 4. You know, when you take out those 7 stocks, and it's the S&P was up only around 6, and so it's like, you're overly weighted in those 7 companies that have performed due to the AI push.
Yes.
Yeah.
So that's what's driving the markets. It's still been the AI stuff.
And some of these names have come back in a big way, even much more than the index has come up, and it's almost not even traceable unless you have, an account that has that specific stock, and you're like, wow, that's really, really done well, because overall the market or overall the indexes haven't done as well as as some of these individuals, and the flip side of that is haven't done as poorly as some of these individuals, because some of the stocks are down tremendously, and again, very stable type of businesses. If you take energy businesses, we're still at pretty high levels in terms of what oil costs, and you wouldn't know by looking at the oil stocks. Energy stocks have not knocked it out of the park. They're not even keeping up with the base commodity growth, which is again strange, because they take that base commodity in, they do all this fancy stuff to it and add all this money to it and then sell it, and you go, yeah, but that's not a good business. We need to be buying
All tech,
this over here.
all AI.
So it's fascinating.
So let's talk what else is driving the market. Let's talk inflation a little bit. And this isn't that exciting, but I'll put up a chart on inflation, because this is really probably the main thing on everybody's mind, and the main thing that's talked about. So right now, this is a CPI inflation chart, year-over-year change in consecutive months above 3%. So we're at 37 months over 3%. So longest period since the late 1980s. The peak was 9.1% in June of 22. But the real important part here is that the market, again, we talk about this all the time, the market is an anticipatory, it anticipates what's going to happen and reacts ahead of time. So there's been this anticipation that, inflation was high, but it's going to continue to come down. Eventually, it's going to get down to that 2% range, which is what the Fed wants. And so because it's going to come down, they're going to cut rates, and we're going to get this rate cut, which is going to stimulate the economy. So it's all tied together. And so far, we haven't seen that inflation number come down. It came down off of the 9s, but it's still in the 3s, and now 3.5, and not moving off that. And so you're not getting, which again we just talked about a little bit with tech, which is why it's so interesting, because typically tech wants lower cost of borrowing, which requires lower rates, which means rate cuts, which they're probably not going to cut rates if inflation stays high. So it's kind of been a juxtaposition a little bit, but inflation has not come down like they wanted it to.
And that's not 3% year over year or total inflation.
No.
we've talked about before, inflation is still high. It may
Right.
be coming down. It's nowhere. It's not down to that 2%.
Growth rate comes down.
Growth rate, yeah.
Yeah, exactly. And I think last time we showed a chart too, and the inflation's like anything, it's compounding. So if you have a 9 and an 8 and a 4 and a 3, it's not. I mean, everyone thinks, oh, inflation's at 3. Yeah, but what about like the last chart I showed, or last 3 years was when prices are up 17%. That's a pretty good number for people.
Cumulative.
Yeah, cumulative. So you get to 4 and 5 years and it's up, 20, 25%. I mean, those are big numbers. So that 3 number kind of distorts it a little bit. Like, well, it's only 3%. No, 3% year over year and every month that changes and it compounds on itself. So, but that's where, like I said, so anyway, the market, on that note, talk a little bit about Fed funds. And this is something we've discussed ad nauseum in this podcast, is that the market pricing in rate cuts. Again, the market's anticipation of what the Fed's going to do. And at the beginning of the year, there was going to be 6 to 7 rate cuts. You can see that. That's the blue line up there. We were going to be all the way down at 383 by the end of 24, and now they're pricing in 1 to 2, I should say. And every day that goes on, it looks more like 1, and potentially again, my
0.
prediction's been 0. So it'll be interesting. The market just has this idea that we're going to have to cut rates. Hopefully we don't have to cut them for the reason that the economy's in shambles, and that's typically the reason that rates get cut. But they keep thinking the rates are going to, we're just going to have to go back to lower rates because these rates are too high. It's like an arbitrary too high number,
which doesn't exist.
Correct. There's no such thing.
We could be at these exact same rates 3 years from now if things keep muddling along the way the way they are, and nothing really breaks either direction. Start getting big inflation again. I mean, again, with oil prices, I mean, oil hasn't run away, to the upside. Like, I think you go back like 10-ish years and go, well, where's oil gonna be, 10 years from now? And people go, oh my gosh, it's got to be $200 a barrel. Yeah, I mean, at $250 a barrel, this is immediately gonna, and somehow they keep finding it, and somehow they keep pumping it, and somehow things keep going. And it reminds me a lot about like even this economy, in this economy, just how things are just resilient. Whether it's persistent inflation, whether it's the stock market not having a complete crazed move to the upside or crazed move. It just doesn't. It hasn't. We're going to talk about what volatility later, but it hasn't felt frenzied in a very, very long time. Even back in 22 when it was kind of it was really tough market in 22. It didn't feel frenzied even then. There were
that was me knocking on this wood right
I hear it. I heard it.
Way to go, Jason.
I felt it.
Well, the other thing too is I should, again, we're not perfect on the podcast. Sorry, I should have printed out this chart. If you ever look at it, we'll do it next time. If you go back historical Fed funds rate, historical interest rates, like everybody has a very recency bias that rates are always low. Like they're always in this much lower than they are now, and it's just not true. We had a very historic period of low interest rates for about the past 10 to 15 years, and that's not the case over time. I mean, I think the high on that chart, again, I'm drawing from memory, was somewhere in 1980. I want to say it was summer of 80 or summer of 81, and rates were like 17 or 18%. And that wasn't, that was an anomaly for the time. But if you look at that average number over the course of interest rates, like we're not above the average right now. We're very much in line with what things have been for a really long period of time. We're very much over what it's been in the last 10 years. But again, this is that whole
even 20 years.
Yeah, it's got
that's where you get the recency
lower.
bias from.
Yeah,
is because it's been a very long time since anybody got a mortgage. It was 9%.
Right.
On a regular basis. There's been little spikes, obviously, just even in this last year where, we read anecdotally about, somebody's got an 8.5% or 9% mortgage, but those are not super common. You're really looking at the 7s and 8s and maybe even the high 6s right now, and people are able to swallow that. We still don't have a tremendous amount of supply on the market, and when things do come up, it seems like they get snatched up pretty quick if they're priced even close to what it should be. So
yeah,
with inflation too, I was going to mention. You got to think about it. Many say that the cause of at least the initial inflation was the overprinting of money, right? But we're still running a $2 trillion deficit and still printing money.
Yeah.
So if that part doesn't change, I don't
it's
understand how the rates are going to come down.
Where a lot of that is going, because we're not as a country, we're no longer, pushing down these big stimulus checks, but it's costing the government a lot of money to, to spend what they spend on all kinds of other things, whether it's foreign support or whether, the domestic
Social
programs.
Security got a 10% bump. So all that money is going right back into the economy.
Massive number. Yeah.
Yeah,
So, but I don't think that's getting financed through the deficit. I think that's still coming through payrolls, because payrolls are still, payrolls is still pretty robust. There's a lot of people who don't have a really high unemployment. There's all kinds of things that can break. And a lot of those things, it just seems like they're, it's treacherous, and this is, they're jacking up the, minimum wage again in California again. What was it, over the weekend? I think there was another sector of the market that got bumped up. Healthcare workers are going to there's going to be a new minimum wage number in just for healthcare people that are classified as healthcare workers. There are a bunch of these things that are happening, but they're almost non-inflationary because AI and all these other tech tools are able to replace the people that you're trying to pay more. So if you go into a fast food restaurant now, it's actually really difficult.
Monitors.
It's really difficult to find somebody to give your order to, because they've eliminated all the people that used to stand around the cash register. They don't even exist.
It's inflationary when you go try to buy the stuff at the store, though.
Right.
When you go to the grocery store, you go to the fast food, and you look at what it costs. There's no longer a dollar menu.
I was thinking about we don't go to fast food very much, but I went to the McDonald's the other day, and the first thing they say is, "You want to use the mobile app?" I'm like, "No, just regular. Just want to give you my order and have you take it."
Well, just a moment, sir. We have to find somebody to do that.
I mean, I'm in the drive-thru, like you're talking to me. Why would I use the mobile app in the drive-thru? But that's where it's gone.
Yeah.
But again, that like you said, that you keep increasing minimum wage. Well, they're going to find ways to make things cheaper, and computers and AIs
or go out of business. And I think you'll see more and more stores will just close and go, "Hey, we can't do this."
Yeah.
And that's ultimately that's not really what the aim of raising a minimum wage and making a livable wage, and all the terms that are used to try to artificially boost that up. But it's the lower sociodemographic that ends up getting hit really, really hard with inflation. And wealthy people will still they're still buying yachts. It's not going to affect the people at the top in the same way. So
you mentioned that a mobile app. Here's where that AI will come in. I think because I hear it every time too. I'm like, why are you asking me about the mobile app while I'm already in line with people behind me?
Right here.
And they're training me. So then next time I come to a fast food line and I see 12 cars there, I'm like, mobile app. And so before they know it, everyone's just sitting in the parking lot using the tech. And there's one person working inside just running food out.
Have you been in a Starbucks in the morning?
Mm-mm.
So they're typical
orders.
Yeah. You typically walk into a Starbucks now, you go and get your coffee. There are 30 cups that are already made, and a couple of food items or whatever, and there's one person in line. People figured out, because you don't have to go. Again, a long time ago, you used to go into the Starbucks and you'd hear everybody spew out their order. I mean, they have Saturday Night Live skits on how long the orders are and all this stuff. But now you walk in and it's quiet. You hear the workers working. There's really not a lot of activity in there. Everybody's buying online, so they don't have to stand, or on their app, so they don't have to stand in line. So everything's ready for you when you arrive. So it's interesting.
So I did want to mention, we talked about housing. So housing affordability index, we mentioned rates, and rates are probably about 7% right now for a 30-year fix, which is what most people get. And we have that combination of, rates up high, but people have existing fixed mortgages that are, they're low, and they don't want to trade out of them because they can't afford that next upgrade house. So housing affordability index is at its lowest level since July 2006, which was right before the financial crisis, driven a lot by real estate. And then before that, you'd have to go back to 1990. So a lot of questions to be answered coming up with housing and rates and how things change, because like I said, I don't see a lot of people getting out of that 3.5% mortgage to take on a 7% mortgage. Again, because you're typically not, especially people that are not older and stepping down in size, you're typically at least lateral or moving up. And now it's more expensive because it's a bigger house, and now it's more expensive because of the rate and they can afford it.
Cost of goods haven't come down much on housing either. We saw lumber go crazy for a moment. It came back down, but it's just been holding. Watching in the construction industry, talking to clients too, a lot of it, I mean, whether it's concrete or lumber or everything like that, it's just holding. So the cost of building a home has not come down. Labor's gone up. And so houses are still expensive. So supply is still short. There's not that many homes being built. There's a lot of red tape to build a home.
Regulations.
Permitting is taking
Fire
longer
sprinklers.
now to get in.
Solar.
And so it makes sense why prices are sticky. You know, people don't want to leave. And then the people that do, there's not that many homes to buy.
Yeah, and it doesn't seem like there's anything really there to soften up the home prices either. There are. I was reading this morning. There's something like 30-something% more houses on the market than there were this year that are priced over $1 million. But some of that is because the prices have just moved up. You know, if you get a 10%, which I think that again in the West the number's something like 9% higher than it was this time last year. There are less houses being sold, so less transactions going through to the tune of like 2%. So about the same number of transactions, just the price levels are higher. But there are a lot more homes that are, relatively speaking, a lot more homes that are on the market that are over $1 million. But if you price it, if you're anywhere in our area between 4 and say 700, those houses go like that, 3 or 4 days, and they're on the market and they're gone. There's just no supply.
You look around, and it's like your neighbor sells their house for $1 million that you thought was $750 or $800, and so now you get people that are older that are looking to downsize. Well, hey, let's go test this market. Let's see what I can throw out there price wise and get someone to bite. And especially around here, if you're out there on land or property, you're getting a lot more than what you thought you would have 6 months ago, 12 months ago. And
Yeah,
so that's kind of keeping prices up and inflated too. So
and I mean traditionally, what breaks the housing market are when you get a big downturn in employment in the area. So the Navy decides to close a base. I mean, that's going to be a huge shock and something you can't account for. Or interest rates go way, way, way up where, people can't. And the other thing that happened certainly in the financial crisis was a lot of adjustable rate mortgages, right? And those adjusted right into people and ate them up. And I rarely hear of anybody doing adjustable rate mortgages anymore.
No.
As far as the people that we talk to and clients, and even probably mortgage brokers, we could call them up right now and go, hey, how many of those are you doing? And you go, more than last year, but not very many.
Yeah.
It's an interesting thing. Jumbos too. Jumbos traditionally, if banks wanted to be in the jumbo market, they would price the jumbos just right, and the jumbos are much more expensive now than the conventional mortgage.
Which says they don't want them on their balance sheet.
Which says they don't want them. So yeah. No, I don't see how housing corrects in a meaningful way for the foreseeable future. Not that it needs to be going up 9% a year. I think it's probably unsustainable. And you have a hard time bringing it. And again, in our market, we're a little bit different because people from the Bay Area and LA still think this is inexpensive. In our space, but
and it is.
It relatively
For them.
it is if it's the right situation. But a widespread housing correction is probably not really in the cards. So,
one of the things that transitioning a little bit that we talked about last time and hinted at is elections, right? So it's an election year. In case anybody didn't notice, it will dominate the headlines and the news cycle. I mean, obviously with trials and things, that makes it even more of a front and center news cycle. But every time we have an election, I feel like we get the calls that say, okay, well, it's an election year. What's that mean for the markets? What if ABC guy gets elected or DEF? I mean, Republican, Democrat, current, new. What's it look like to the markets? And so we've used these charts a lot over the years because, elections happen every 4 years. And it's always a question, well, you favor one party over the other personally, and you think that if this doesn't go your way, then the market's going to just fall apart. And so one of the charts that we put up here right now is, essentially investing in the market only during an election year or a non-election year. And so what you can see is that overall from the market, this is just comparing between the election year, non-election years, they move pretty much the same. And so it's one of those things that it doesn't dictate or cause markets to react one way or another just because of its election. And we said over time too, markets are politically agnostic. They're not going to move one way or another drastically just because of a particular political party.
I think what you got here too, Kyle, what this is
short term,
it's laying on is basically
Days
between
after
election
reaction.
and inauguration.
Yep.
Because I remember just in the last couple of elections, especially because they've been pretty polarizing. That if their candidate didn't get in, then they thought the world was going to end. There's going to be wars and pandemonium and everything crashing, and oh my gosh! And then turns out when you compare it to non-election years, the other three, it's just the same.
I think that's kind of by design. Wish people would figure that out.
But the last few elections, like you said, it's been more polarized. I know personally, I've had a number of clients calling in, and August wanting to know, hey, should I get out of the market now just in case so and so gets elected?
Right. Yeah.
No.
Did we put the chart in there that has the difference between the two long term? If you just invested during Republicans or just invested during Democrats?
Yeah. So
we put that one in there.
Yeah. So this is it right here.
Okay.
It's one of them. We have a number of them here, but this is going back. So I mean, between the two, obviously, it does show that Democrats have had a little bit higher annualized return over the Republicans. But the more important number is, so what the chart's showing is if the red lines, if you just invested $10,000 when a Republican was in power, it goes to 77,000 value. Blue is in Democrat, it goes up to 405,000. But if you just stayed invested the entire time, regardless of which party was in power, you're getting an 8% annualized return. And that $10,000 is, $3.1 million over that period of time.
Mm-hmm.
And so, again, it goes back
So you're
to
out of the market 4 years.
Yeah, exactly. You're in the market out forward. I guess it depends on what time period and, if it's, back-to-back elections. But, yeah, I mean, bottom line is it's really hard to time the market. And it's always the amount of time that you get to spend and invest in the market that seems to add those levels of returns versus trying to get in or out. And if you're going to miss 4 years or 8 years of a market, usually not going to be favorable.
Yeah. Right. And there's so much too that, I mean, the political party in charge in the White House has so little to do with market performance. It's so overstated that, I mean, like this, Democrats have done better. I mean, a lot of these decisions they're making don't have effects for, 5, 10, 15, 20 years. And so they make a decision, they, pass a bill, whatever, go a certain direction, and then take the credit for the next 6 months. I mean, it's actually ridiculous. So again, back to our point that whoever's in power, I do believe that elections have consequences. I am a believer in that. I do think that over the course of a long period of time, you will see those consequences shake out, but not over a 4-year period where that person's in charge.
And what this chart doesn't show, and I wish we had the other one up right now, but it does show times when it's not this one, but I didn't put it in there. But when it's Republican or Democrat president, and then what the makeup of Congress is, right?
Yeah.
So, because again, the president is just one branch of government, right?
Yeah.
Whereas if it's a split government between a Democrat and Republican-controlled Congress or vice versa, those scenarios the market actually has done better than one party controls all three branches of government.
Yep.
The system is designed to be gridlocked.
Correct.
Everybody gets frustrated with gridlock, but the real design around it is so that things don't just get pushed through easily.
Less government.
Not just less government, but certainly checks and balances, constant checks and balances. And the design is that the branches and the parties are gonna bicker and do these things, and so we don't just get wholesale rule changes right away. At when the wind changes. Oh, okay. Well, we're changing and we're doing this over here. Well, somebody needs to check that or balance that. And I when I see people complain about gridlock, I see that as that's really the way the system's supposed to work. That's what you're watching that happen, and it's ugly. It's always ugly, but that's really the way it's supposed to be.
Well, I said too before with regards to a business, right? If you're building a business or running a business and you're trying to have a business plan and a 5-year business plan, and you have one party in control, and there's going to be constant change because they can do more than they could if it was divided government.
Yes.
It makes it really hard to have a 5-year plan, not knowing what changes are going to come through.
Right.
Whereas if it's gridlock, like you mentioned, less gets done. It's a lot easier to be
and rules don't change often. Yes.
Exactly.
Yeah. And like you said, when you run a business, whether it's a publicly traded business or whether it's a small business or whether it's a lemonade stand, you gotta know what the rules are when you start. And you hope if you build the plan around those rules, whatever rules those are, then you hope those stay in place for a long time, because then you can actually operate an entity.
And one other thing I'll just throw out there too is, historically speaking, in election years, with the exception of about 4, they have been positive, and usually those 4 are significant, right? It's financial crisis,
right.
It's .com. I mean,
they're major events that occurred. So again, because whether you're party in control, you're trying to keep things even keel as much as you can to increase your odds or favorability. And so markets tend to be a little more stable and historically positive in election years. Not every time, not guaranteed. I'm just saying historically, with the exception of about 4 times, election years have been positive for the overall markets.
Yep.
Awesome.
So
Fixed income.
Yep, there's another one. I guess we could have piggybacked that a little bit off of Fed rate and inflation and all that too. But so I guess I'll be the first one to eat a little bit of crow here. And one of my predictions.
You're talking about you were right.
I know, 0.1%, right?
1 basis point.
Yeah, 0.01. It just fixed income's been a really tough place for the last 2 years, 3 years coming on, right? Talked about that a number of times over the last 2, 3, 4 roundtables, and when interest rates went straight up, our fixed income prices came straight down, right? And so we had really poor performance in the fixed income area. And one of the thoughts that I had as rates have kind of peaked, again, none of us thought we were going to see 6 rate cuts, even though that's what was forecasted, but we thought maybe 1 or 2. And so historically speaking, when rates start to come down, we start to see an appreciation back and a rebound in those bonds. And so yes, I guess we're a little early. We haven't seen a ton of climb back or growth in the fixed income area. We're being compensated with the rates now, so that's nice. So we're at least being paid again to hold those bonds. But I have a chart here because we keep saying, well, is the Fed going to change rates? When are they going to change rates? And essentially what this is showing here is, comparison during the rate cycle, the rate hiking cycle, and versus when the Fed starts to cut rates. So bottom line is if you start investing back into the fixed income, so a lot of us have gone shorter in duration or in treasuries or money markets or CD rates and things during this period of time. Mm-hmm. But the question's always been, okay, well, when do we kind of start rebalancing or reallocating back into intermediate term bonds or our core bonds again? And so a lot of people tend to want to wait until the Fed actually starts cutting those rates. And as you can see, that hasn't been the case yet. We don't know when that will be. It's just they keep kicking that can down the road. But what this shows is that if you kind of just wait to the end of the cycle where we've seen the rate hike kind of peak. We don't see any more rate hikes coming. Doesn't mean it can't, or data can change, but right now it hasn't really forecasted any more hikes, just cuts. You see that if you start making those allocations back into that intermediate core bonds, you start being rewarded more so than if you wait for the Fed to actually start cutting rates. And so I guess my prediction was a little bit early, but it is still positive since our last one. But it's still a space that I'm cautiously optimistic that we'll start seeing some positive principal growth too in the fixed income area over the next couple of years. One of those things too is the amount of bonds that we see trading at a discount. And so I have a chart here, and if for clients or people that aren't aware, so par value for a bond is $100, right? So when demand's high, they'll drive the price for that bond up, and so it trades over par value, 101, 102, 105, depending on the bond duration and credit quality. But par is 100. So if you bought a bond and held it to maturity, it's worth $100. In between is kind of
either way.
right?
That's what's important.
So if you bought it for 105 and hold it to maturity, you're getting 100. So you lost 5% in the meantime. But so historically speaking, the average bond price is around $101, and that's just what it's been on the active market when it's trading. As I said, par is 100, and this chart on the left shows that roughly as of the end of March, the average bond price round is $91, so trading at a discount. So again, if you buy a bond, whatever price you pay for when it comes to maturity, it's worth that 100. So about 85% of the bonds now are trading at a discount or under that $100 par value. Mm-hmm. So kind of reversion to the mean. So I think some of those returns that we're going to see in the fixed income space going forward are no longer just coupon or interest payments, right? It's the reversion back to that par value as these bonds start to kind of come back up in that value. So like I said, those are two of the factors that are kind of leading me to be a little bit more optimistic on the fixed income space.
Well, I think the thing with fixed income too is that people expect that rate cuts would obviously drive bond prices up, but that's sort of an artificial juicing in the short term. Like Kyle's explaining here, a $91 par value price bond, a $91 price bond that comes due at 100 naturally has to accrete back to 100. Okay. If rates stay exactly the same and nothing changes in the bond and nothing changes in the market, it will come due for $100. So right away, you're getting that 9% back plus the coupon payment. So even if rates don't go down, which we talked about earlier, that, hey, we don't see at this point any reason for rates to get cut, bonds should be set up for, again, would you rather buy an asset that's worth $100 in the future at 91 or 105? I mean, obviously 91 is a better number. So if you have bonds that are under par value right now, they're going to accrete up to that value over time.
Yeah, and some of that you may be just giving up cash flow too, because you just did the reason. Part of the reason that those are pricing down is because the coupons are small. They're tiny coupons on them. So, but you know, having that already built in, not having to just worry about cash flow to to actually get your bond heading in the right direction. I think that will be big, and I think with interest rates where they are now, and whether it's the Fed or the Treasury issuing new bonds at higher coupons, or corporates or munis at higher coupons, that's just easier to deal with from a cash flow standpoint. Also, I mean, it was hard to buy, an 8-year bond that had a 40 basis point coupon on it, a few years ago. It's just like, what are we doing even buying these things at all? You get no cash flow off of them. So, the cash flow is going to be better. Obviously, the accreted nature is going to be better too. So.
And we've talked about this in the past. I mean, there's nothing wrong with treasuries or money market. I mean, for cash management purposes, it's great, and then the rates are extremely high, and we've had a lot of clients take advantage of that. But if you're talking a market cycle and a true investment performance over the next 5 to 7 years, is money market going to do better in T-bills or bonds with some actual duration? I would say bonds with duration. And that's the difference between really investing for a period of time versus what we call cash management, which is, hey, this is short-term money. I may need this in 6 months, 9 months, a year. That's perfect for T-bills and perfect for money market. But not you don't want to get out of investments to go into really short-term solutions, because in the long run, those are probably going to underperform.
Yeah, historically, they don't outperform inflation.
Yeah.
So it's still kind of eroding at your purchasing power and things we've already talked about.
Look at any chart or any period of time, any significant period of time that compares cash equivalents, short-term bonds, treasuries, money market, bonds, and stocks. It's not even close.
Yep.
Not even close over any period of time you take. So again, but it has to be, a market cycle, not, 6 months to a year.
One last chart I'll throw up there on fixed income is the inverted yield curve, right? So we've talked about that. It's officially kind of the longest inverted yield curve we have had. And so what that means, I know we've hinted at it before, talked about it before, but essentially, long-term rates are paying less than short-term rates, and that's essentially, again, forecasting in the Fed rate cuts here. So that's what we've seen. It's been going on now for the longest in the history, roughly just over 19 months. And yes, we've had really positive performance in the stock market during this period of time, above average actually, and flat to negative performance in the core bonds. But the table on the right, the second part of it there, is showing that historically speaking, performance for bonds following the inversion of the yield curve, which again, we're still inverted, but again, once that kind of starts to normalize, you've seen some positive returns in that core bond space, which is what we were just talking about. And so again, not saying bonds are going to go up 10% this year or next year, but it's one of those things that I think that we should start seeing some principal appreciation in our bonds on top of the higher coupons we've been starting to lock in and receive on the interest side. So that's kind of all the things that are factoring a little bit of the cautious optimism here. But as I said, I haven't seen it the first 5 months of the year yet.
This chart reminds me of something else. We've all heard in our career that you need to get out of the stock market the moment the yield curve inverts.
Yep.
CNBC ran with this heavy a year and a half ago.
Yeah.
Hasn't worked out.
No.
This is another
Forward-looking
expectations.
expectations.
Anytime you see something, well, every time this happens in this election year, the inverted yield, get out of the market, get out of the market.
It has to be a recession, right?
This is another evidence, because anytime you try to time the market, getting out is easy. You hit a button, you're out. The hardest part is getting back in. So anyone that got out of the market because the yield curve inverted, because CNBC told them to, or 63% of the time it's worked or whatever, you would have had to. You're either still in cash, kicking yourself, or you're going to be forced with a decision on when to get back in. And I didn't know it was 19 months, but that's crazy that we've been inverted for 19 months. So anyone who got out of the market because the yield curve inverted, which there was a case for that, it's been a year and a half where they were just waiting for that correction. And by the time the market actually corrects, and I'm sure it will at some point, it'll probably just go back down to a fraction of what it peaked at, but still well above where they got out.
Yeah.
Well, and they'll talk about
We can
that
only
far
hope.
right part, right? So they've been out, but they've got that 5% in their money market cash or short term rates that they've been able to do, and so they're still viewing it as positive. But again, then it comes back down to reentry, right? So markets are 21% higher roughly. So at what point do you get back in from where you got out? And so it's
Yeah. No, the biggest, I mean, this is a mouthful, but I've said this a bunch of times whenever I talk about the market is a multifactorial, organism, for lack of a better word. And there are so many factors that influence the market and so many that I don't understand on a daily basis, or at least understand why it's moving a certain way. And sure that experts don't understand, and surely the average investor doesn't understand. So when you see one signal, and this is kind of the way we've gone, again, I'm getting a little philosophical, but kind of the way we've gone as a society, we want to break multifactorial things that are very complex and have a lot of variables into one single answer. Because it's easier that way. We can understand it. Oh, inverted yield curve? Always get out of the market. Always. Well, not always, apparently, because it didn't work. So all of this stuff, again, with the market and the whole, that's why we go through these things, the elections, all these different factors. They're just a single factor that could possibly influence the market, and there's so many other factors. Except the one thing we understand is that, prices and prices will probably move forward, move up. The world will probably keep going. Things will probably be more expensive in 10 years than they are today, and that's the purpose of investing.
Agreed.
So one question we've been getting, so we do like to do top questions from clients. One question we've got a couple of times, I'm going to throw it to you guys, but I'm going to stage it a little bit, is that we're getting more and more people that have significant money, let's call it significant wealth, and they know that it's going to go to their kids, or inheritance. But rather than wait until they die and then pass it on, they want to see they personally, as clients, would like to see their kids or their inheritance have some enjoyment out of that money for things they could actually use right now. Rather than, again, you're dead and, hey, great, that they're going to get it, but you don't get to see them smile or use it or, use it over the next 20 years, however long they have. So we've got that question a couple of times recently on how do I give money to my kids or my inheritance the right way. Are there rules on that? And this kind of crosses over into what we do working with CPAs as well, because this is definitely a CPA question, but it's something we have some knowledge over. So when do you guys want to take that on?
I'm seeing more of it too. I think, a very old way of thinking. We deal with clients of many generations, and you think of some of the first people that we ever dealt with and some of the oldest people we've ever dealt with. It was always the case where money was very secretive. You kind of keep it hidden, didn't really discuss it with your children, and then you die, and then they get it. And that's kind of the way that it's always been. And it's like, well, I'm going to keep this from them. They're never going to know about it until they know about all of it.
Right.
And it's like, what's the point? And then by the time, if someone's fortunate enough to live a long life, and let's say they live into their 80s or even well into their 90s, by the time their children actually get it, and oftentimes they don't need it. They've already gone through the struggles. Yep. They've gone through the hardships. Their home might already even be paid off. And now they're getting this potential windfall of money. Mm-hmm. And now they're dealing with more estate problems on their end because they didn't even need it at that point in time. And so if there's a way that it can be structured, that when your children are in their, let's even say their 20s, 30s, 40s, 50s, things like that, where they're going through stages of life, and you can structure it in a way that they're going to get the money anyway, but you're able to see the benefit from it now, help it now, or maybe you're doing traveling or trips with your kids and grandkids, and you're able to actually enjoy this money and see your grandchildren enjoy it, as opposed to just leaving it on top of your tombstone.
Yeah.
So we're seeing, and then there's ways that if you do want to transition some of that wealth, you can also take advantage of tax strategies too. Mm-hmm. We can mention gifting and things like that, but that's where a CPA getting involved in estate planning, trust work, things like that can really help, as opposed to just keeping everything hidden in the bat cave and then just die.
So
load it on everybody.
Let's ask it this way: if you had a client that called you up and said, "Hey, I want to give $100,000 to my kid because I'm at that point in life where it's excess. I think they can use it more, and I have all this money in XYZ stock, and then I have cash." What are you telling them to give?
Yeah. So, it depends on their net worth too.
Mm-hmm.
Okay. It depends on their net worth. Because right now, a lot of people, and we get these questions too. This can get complicated, and this is not everyone's common language, but they think if they give their child money that someone's going to have to pay tax on this.
Mhm.
It's going to be income or something like that. And that's not the case. You can give your kids, frankly, as much money as you want to give them. But we're allowed in this country to die with a certain amount of money without having an estate tax. Currently, that number is $13.61 million per spouse.
Don't get excited because that changes.
Per person.
Yeah.
Per person.
per person, or 26 million if you're married. And that number changes and it has potential to go down, go away, go up. We don't really know, but that's what it is right now. And so you can give as much money as you want to anybody, but we can kind of break down how that works. So if you give $18,000 or less to anyone, then you don't have to record it. You don't have to tell the CPA. You're staying within the gifting limits per year. But if you want to give let's say you give your son or daughter $100,000, then any amount in whatever tax year it is, any amount that you're over the limit of what you can give, it's not taxable to your child. It's not taxable to you. You just got to tell the CPA what you did. They're going to put a little note in your file. And then instead of you being able to die with 13.6 million, you'll be able to die with 13 point whatever it ends up being above what you gave. But if a person's got a net worth considerably less than 13 million, then don't stress over it. Give your kids what you want. But for the clients of ours that do have net worth that may be near these numbers, if they've got a sizable net worth now and they're 50 years old, they might be struggling with estate taxes at some point in time, then they can start doing these gifting strategies. They can, if they're married, they and their spouse can each give each child 18 grand. And if their kids are married, they can each give the spouse or their daughter or son-in-law another 18 grand, and they could do it to the kids too. So you could really start getting,
So instead of
getting a
so
lot of
people
money out of your
understand,
estate.
instead of doing, you think father and mother giving their son or daughter 18 grand was actually 18 plus 18 plus 18 plus 18.
Right.
Because each the father and the mother can give to the son or daughter, and each the father and mother can give to the son-in-law or daughter-in-law.
Correct.
It's the same family. We're in community property states, so.
Correct. And that's not even including grandchildren. That's not including 529s. And so there's a lot of ways that you can begin getting money, quote, quote, out of the estate if you have numbers that are going to be potentially near that. And theoretically, we all might, because we don't know what it'll be. You really need to know who the president's going to be when you die. And then you might have a good idea what the estate tax limits will be.
Well, even then, so I think what we're dealing right now is you're talking about estate laws that went in about 9 years ago at this point. Because I think in 2026 they sunset. And so the 13.6 right now, if nothing happens, if no law changes, it's automatically going to go down to $7.5 million a person, which again is for a pretty small group of society, but it's going to impact some people. So
talk real quick about what happens over 13.61 or 7.5 million. What happens over that
so
number?
let's just say a single person, just for ease, dies with $15-ish million. Then everything above that 13.6, and again, don't cloud it up with retirement accounts and other things like that. But just you died with $15 million of cash in the bank.
And land. Or buildings.
I'm saying you don't own anything. You rent an apartment.
Okay.
You have a cash account at the bank that has $15 million. So nothing complicated. Your estate is going to have to pay estate tax on everything above that 13.6. So in this case, it's 1.4. I'd have to look up what the rates are, but it's in the 30s. It starts in the 30s at the low end. So 30-ish% of that excess $1.4 million would be due in tax. Some goes to the state of California, some goes to the federal government. If you die with $13.59 million, same scenario. You live in an apartment, you have a massive bank account. Your estate has to pay zero tax, and all that goes to whoever
Zero estate tax.
Zero estate tax.
And what Jason was saying is a good point. It's the full value of the estate. So your house, your land, your everything that is included. That's the value of the estate. So. Again, $13 million is still a very large number for most people, but it's not $13 million in the bank. It's $13 million in your entire value of your net worth.
Well, and one of the pitfalls that I think we see clients get close to that we try to keep them away from is they'll typically want to give things like stock, and the problem with doing that is, especially if you're really doing late stage estate planning, is whoever inherits that. If they inherited it after you passed, they're going to get the current market value as what they paid for it, essentially, what we call cost basis. So they're going to get that number. So if you bought a stock in, years and years ago, and you paid, after splits, you paid
you
$1.
bought NVIDIA 20 years ago.
You got a lot of money.
You wouldn't want to gift that.
Not while you're alive. But if you pass away, the new cost basis for that stock is whatever the current market price is on the day you passed. So if your family member or whoever inherited sells it after that, they're not going to have to pay for the capital gains tax all the way to when you bought it. But the error that sometimes is made is they want to gift down. They'll gift to grandchildren. They'll say, "Oh, I'm going to give them 1 share of NVIDIA, and I'm giving 1 share every year during Christmas." And then, when the kid wakes up to go to school, as a college sophomore, and they go, "Oh, I have those stocks. I need to sell them." They get they get the original cost basis that Grandpa put in place, and they're going to have to pay all this capital gains tax on the difference. And so we try to say it this way: if you're giving to people, you want to give cash. If you're giving to nonprofits, you want to give appreciated securities or appreciated anything. Yeah. Because the difference between those, the nonprofit doesn't pay the difference in tax. You get the full full credit for the gift based on what the market value is, and it doesn't. There's nobody assuming your old cost basis. We get to sort of clean that up. But if you're giving to family members, whether it's holiday gifts or whether you're doing planned gifting around around your estate planning. You want to try to give cash where possible, unless you're doing something really complex that your attorney has to build specific trusts for, and that's not part of this conversation.
So quick scenario: client wants to give, say they're going to buy a house for their son and daughter-in-law, and they're going to give them $250,000. What's the steps for that in that particular year?
So if you just want to make it easy and just give. And let's assume it's 2 people, right?
Yep.
So you'd be able to 2 living donors and giving it to 2 people.
2 gifters.
You'd be able. What would we say the number was? $72,000. So it's basically dad gives $18,000 to son and daughter-in-law. Mom gives $18,000 to son and daughter-in-law, and that gets the 72 out.
And then what happens to the rest?
The rest you can do it one of a couple ways. Some tax consultants that we work with will say, "Hey, take a loan, structure it as a loan, and then forgive $72,000 per year, assuming that number doesn't go up.
Yep.
Forgive $72,000 a year going forward, and then you don't have to worry about the unified credit exemption and take anything against that. Or
we're
just
really getting into the weeds here.
Yeah, just take that other at roughly $180,000. Take that other $180,000 and just take it against that $13.6 million exemption, and just wipe it against that.
And if mom and dad have got a sizable net worth, I agree. You know what I mean? But if mom and dad are worth $1 million, a couple $1 million, they really want to help their kids. It's unlikely going to be an issue.
Right.
Another thing I was just thinking as you said that, though, you could always have the kids buy the home in January. Gift them $72,000 in December 15th, and give them another $72,000 on January 1st.
That's $144,000.
And so you're knocking out a lot of it, but you're all within a 30-day period of time because you're jumping between 2 tax years.
Yep.
I think the most important thing on this is that just so us to get a chance to talk about it, and so people can hear. This is why you want to bring these things up, because there's lots of. I mean, we've mentioned a bunch of different terms here. Estate tax, gift tax, annual exclusion,
step up.
I mean,
how about cost basis?
Cost basis. I mean, there's all these things, and honestly, it shouldn't be fearful. They're like we're seeing a lot more of this. I think it's a great thing. I think we all encourage it, especially for clients that have the means. Of course, you want to see your offspring or grandkids, whoever, enjoy the money that you may not need, but bring it up so we can make sure that it's structured properly. And help you walk you through it. We like these questions. I mean, I actually really enjoy it because I thought it's a good question, and I wish more people would think about it, and maybe this will encourage people to think about it. I know in the past, like Chris said, we've run into some situations where this is sort of what Jason started with, the old guard, where you hid your money and you didn't really tell anybody. And then right before Grandma died, Grandpa had already died, and right before Grandma died, she wanted to do everybody a favor. And so she gifted them all her appreciated stock. because she was trying to be nice and literally just did the exact wrong thing, because by gifting the stock before she died, they got the current stock cost basis, which caused them a bunch of tax to be due, where if she just would have waited until she passed, they still get it, and it would have been tax-free. So those are the kind of situations where we run into, unfortunately, after the fact, that there's huge mistakes made, and the government's excited about it, but nobody else is.
The good intention is, well, I didn't want that to go through probate or, something along those lines. And the good intention doesn't work out very well.
Bring it up.
Comes knocking.
Goes back to the importance of planning.
Exactly.
100%.
And like I said, sometimes it's just a conversation. In our situation, for what we do, we're not filing gift tax returns or anything, but just bringing it up and talking about it and going, yeah, that's a great idea. You should do that. Talk to your CPA, make sure you get it structured properly. And, it's a good thing. All right. Our favorite part, wrap up and predict.
Whose favorite part?
Mine.
Not my favorite part.
Wrap up
of predicting.
Wrap up and predictions, always fun. I'll just remind everybody from last time. So last roundtable predictions, Jason said sticking with rates higher for longer, tech pressure, and higher volatility. We get a little bit of volatility. We've had a little correction, and we're getting a little bit of that. There's been a little bit up and down.
333.
I'm gonna give you 1.5.
I'm a major league baseball player.
1.5.
Yeah,
That's a really
not
good
bad.
average for major leagues these days.
Kyle, value coming back. Value's not back yet. Fixed income strong. Mortgage rates decline.
I guess you could argue it's back, just not as good as tech.
Yeah, and listen, some of these predictions, the way we think about markets, it doesn't mean it's going to happen in 3 months. So I will say that. A lot of the stuff that we're thinking is longer term, because again, that's what we're investing for clients, a little bit longer term. It's not a 3-month investment. I said, I've been staying with this one, but I think if you get it right, you can stay with it, right? You just can stay with the same one.
I guess.
No rate cuts in 2024. And so far, we're no rate cuts in 2024, and looking like, again, we put up a chart that says 1 to 2. I think that might be a little wishful thinking by the market. So that was mine. And then Chris said value over growth since the last time, and then a little bit lower mortgage rates. And I did look, mortgage rates are right about the same.
They're exactly the number. It was
Exactly the same.
It was 694 last time, and it's 694 now.
694.
So that was an 0 for 2.
Yeah,
Because value has not beaten growth. It's not close.
I know.
It's how you phrase it. Is it back or overgrowth?
Yeah, that's why you went coming back.
Coming back.
Yeah.
All right, Jason, you got anything?
I still think the Fed funds rate can stay where it's at, but mortgage rates can come down. It's been a while since I looked at it, but I recall that mortgage rates are typically within a certain 1%, or maybe is it 1% or 2% of the 10-year. But it usually hugs within about a point. But then we got all wacky there for a minute because the banks didn't know where rates were going, and they didn't want to be caught. And so there was a huge dispersion between where the 10-year Treasury was, the 10-year government interest rate, and where mortgage rates were. So it's likely, as things normalize, that the mortgage rate could come down back to historical gaps between the 10-year. But I'm still kind of in the camp now that this higher for longer. It seems like this 3% inflation is like the new normal. They might be shooting for 2%, but I don't know where they're going to find it. And so they need to see the inflation coming down in order to cut rates. And I don't think they're going to get what they want. I think we're waiting on when's the next hike or cut? September, or at least that's when inflation data comes out. I think.
No, we got a couple more weeks here. We're in late May now, so the next they meet every 6 weeks. So
we'll get
next
monthly
meeting I
inflation
think is
data,
3 or 4 weeks away.
But I think we've got inflation data coming out pretty soon, and if those numbers are not lower than expectations, they're going to have a very difficult case to cut. And I think everyone's waiting or expecting the market to cut rates, well, just because we keep talking about it. Oh, they've got to cut rates, but I mean they don't have to. And so I still think higher for longer. I think that's going to kind of hang around. It wouldn't surprise me. Not that I think people should alter their investments, but it wouldn't surprise me if we do have some more volatility, only because we haven't had any in a while, and we usually see ups and downs and variation and ebbs and flows, and we've had low volatility for a while. I don't know what potential black swan could cause it, but volatility doesn't necessarily mean the market's going to be in a sustained downturn or anything like that. It just means, the seas have been calm for a while.
Sure.
And maybe we'll go through a period where they aren't. I have no idea what would cause that, but it wouldn't surprise anyone if the volatility index went up a little bit. But I'm done calling tech. I don't know where that's going, man. Who knows?
Well, if things
NVIDIA to the moon.
if things stay the course,
There's your top.
The interesting thing that NVIDIA I don't think has been doing that I think they might be in the position to do now is start swallowing up a lot of smaller companies. And just using the stock as currency because it's
Well, now they're going to have more shares.
they have a lot more shares.
10-to-1 split.
I don't think that makes any more
I don't
value.
think that helps it.
Just got to use 10 times as many shares to buy the next thing. But I think that probably ends up helping out smaller companies as they get bought out, investors in smaller companies as those companies get bought out because they'll have huge growth rates too. And so my guess is that's probably next in part of the cycle is just more M&A activity. Because
Microsoft did that for a long time. And now if you look at Microsoft, if you could go look at a chart.
So is Google. So is
of
any of these companies.
Like when you buy Microsoft or Google, you're almost like buying a mutual fund. Of all the companies they've consumed over the last 20 years.
Yeah, no question.
That's a good one because if rates do stay higher, that affects cost of borrowing for growth companies, and it encourages the bigger the behemoth growth companies to just buy those companies out.
Mm-hmm.
And then
they're not short on cash either.
They're not.
They got cash. But the shares are worth a lot more.
True.
A lot more. Next Fed Fund meeting is July 11th and 12th. So, but we could pull your chart back up and see, but I think there's basically zero expectations that they're going to raise or lower, and they're not going to do anything.
Again, they just kind of keep kicking the can down the road as far as expectations of a cut. It's like now they're seeing, they're not cutting. Well, but maybe later in the year. Because again, longer, who knows what's going to happen. But at this point, the way things are going, they're not cutting rates.
Well, they're not taking a lot of heat either. Like, there's not a lot of pressure on the Fed to do anything.
Going up.
Well, not just the stock market, but again, housing market's held up fine.
Yeah.
Job market seems to be holding up just fine. There's not a lot of pressure. Now, there'll be weird political pressure probably at the end of the summer.
That's the interesting part.
Yes.
So that's the thing that people have talked about a lot, and that's the only thing I would say is that from an economic standpoint, there's no reason to cut rates. It'll be interesting. People, again, I've read this. I'm not a political expert, but it seems to be that the Fed and all of the government entities are getting a little more politically motivated nowadays. And if the Fed ends up cutting rates for arbitrary reasons because there's an election, then there's a little bit more. They're supposed to be completely separate. Like literally, they don't care who's in office or what party or whatever. We do what's best for the economy and the country, but it seems to be a little crossover nowadays.
Yeah.
Kyle, anything?
Time will tell.
Oh, so if you're wrong, you're not wrong. You're just early, right?
You're just early.
Yeah. Okay.
You just keep saying it.
Yeah. Right. So, I do think mortgage rates are still going to come down. I think we have seen that rate hasn't changed from our last meeting, but there's still some volatility. There's gone both directions a little bit, come down and back up. So I think those will be lower, probably within that 3-month window, even though we are longer term. And I do think value is going to contribute more than growth still. Not more than growth, but start contributing as well. I still think growth is going to outperform, but I think we're going to start getting that spread between growth and value is going to get smaller. And I think that's something that has been overdue for about 2 years now. So,
what do you think on this? This for all you. What do you think on the difference between megas and smalls? Does that keep going? I don't know how that trend continues.
That's a good question.
I think short term it will, right? So if we're doing this between now and our next roundtable, I don't think there's going to be a huge correction. But over time, I think it's going to revert back to the mean. I think the small and mid caps have to start growing.
Unless the top 7 are all just going to be worth $10 trillion and there's nothing left.
That would be bad.
But I don't think that's going to happen either.
Well, then
but
too,
I could
how
see,
much is that tied to interest rates too, and borrowing power for growth for smaller companies?
Right.
So
using the AI word again, because you could see where the 7, not even 7 anymore. That was a term that got coined, even though the names have been changing. But let's just say the bigger tech companies that were kind of the tip of the spear with getting into the AI and doing these language models and buying the chips and doing all of that. You could see why now, in hindsight, why they kind of led this. But now you might see a trickle down where companies like Costco and McDonald's and Eli Lilly and all these other companies are starting to input it, started to influence it, and started to use it in their day-to-day business. So you could see some of those other styles of companies playing a little catch-up. Not that the tech companies are going to crash or anything like that, but it wouldn't surprise me if you see them just plateau a little bit and let everybody else kind of play catch-up.
Both can be true.
Both can be true.
Well, and again, if you're a growth style company, you get rewarded for growth. That's it. You just have to grow. So by any means necessary. And if you're sitting at the head of the table and you're on the board, you got to do whatever you can. And again, with stock prices being way up, I would guess there's going to be a lot of small companies that end up just getting bought up because relatively speaking, it's really cheap to buy a $30 billion company right now. And $30 billion is huge. That's a really, really big company.
Mm-hmm.
But we're talking $3 trillion companies.
Right.
That's what 0.1% of their entire value. What did you say?
The video was up that yesterday.
Up what yesterday? Up what?
They were up. What were they up? 140.
I think you said 200 billion.
Well, they're up 7%. Help me with the math. They're up 7%, and they were at 2.5 trillion or 2.7 trillion.
So let's call it 180 billion dollars.
And we didn't even find any news. So they were up at McDonald's yesterday.
A whole McDonald's.
Yeah.
Today.
That it actually really does
Company, not store.
It puts it in good perspective, like how big these are and how things might have to change.
But again, when you do these mergers and acquisitions, you lock in based on what the announcement deal is. And
it reminds me. I was just playing over the weekend. I was playing. Do you guys remember the old game of Risk?
Yeah.
So if you ever played, I hadn't played it in like 30 years, and it was just like that. Once you start to get these armies, and you've got 35
Critical
armies in
mass.
front of you, and then my kid's got one little soldier holding up like, God, what was the country?
You cheated.
Ursurol, Kamchatka, and he's got one little soldier on it, and I'm coming in with 30. And he's got his one dice, and I've got like a pile of dice rolling over him. Like it's pretty easy to consume at that point.
Yeah.
We won't even go into why you were just dominating your kid in Risk.
In Risk.
He's got to learn strategy.
He's gonna learn one way or another.
All right. Well, I'm gonna stay with the no rate cuts. I know it's kind of boring, but so far it's one. And we had David Lebovitz on in November last year, and he actually thought there might be 1 or 2 rate hikes. So it just shows how things can change, month to month, and then nobody really knows which direction. We enjoy the prediction part, but it's for fun. And I think over the long run, we do understand reversion to the mean, and some of these things are going to happen. It's just somebody told me one time that it's not, you can be right, but your timing might be bad. And that's the thing about the market. Like if you're betting on things to happen now, they may not happen in the right amount of time. That's why over a long period of time is the best way to invest. Hope you guys enjoyed it. Remember, always reach out to us with questions. Like I said, we love to, we get the questions from clients in meetings or, whether it's in person or Zoom or via email or whatever. We like to use those on the podcast because I know if we're getting it from 3 or 4 people, that there's probably another 20 to 30 people that maybe have the same question. So if you do have questions or you even want us to discuss something on here, we'd love to hear that. You can follow us on Facebook, LinkedIn, YouTube, our website, Strong Valley, which I hear from our slide switcher, Kobe, might be getting a refresh here pretty soon. It's going to still have the same look and feel, but, just clean it up and make it look a little bit better. Always trying to do new things for you guys. And share this. We put out the whole podcast. Obviously, it's long. There's a lot of information, but it'll get cut up into clips. And if you like something and you feel like somebody else might enjoy something or something you're talking about, water cooler or over lunch or whatever, share it with them. And so that they get some of the same information. I mean, our goal with this podcast is to try to bring, the sort of the layperson who maybe understands very little, and bridge that gap between CNBC, which is just throwing you, jargon every day, and you shouldn't watch it or don't have to watch it. And you can just watch this every 3 months and get a decent idea of what's going on. So that's it. That's the recap. Thanks everybody for tuning in, and we'll do it again in a couple months.
See ya.
Sounds good.